9 ways to hack the bank's money legally. In this video, I want to show you 9 different ways that you can get access to more business capital so that you can continue to scale and grow your business with. Now, you can use all of these in a combination, whether you get the first one and you combine it with the third one, or you get the fifth one and you combine it with the eighth one, or if you just wanted to use one to start out with. But I wanted to give you 9 different approaches that you can use to get access to more, again, business credit. So with that in mind, I want to start out with the first one, and that's cap stack. Now, the cap stack, or the capital stack, if you're looking at the the actual term, refers to the hierarchy of financial instruments used to fund a company. And so you have senior debt, also known as like a first place lien, and this is what's used to secure what they call like the priority holder or the priority stakeholder in it. I want to give you a real world example. Let's say that someone has we'll use a mortgage because this is a really common one. Someone has a mortgage and they go to sell the property. Well, the person, or in this case, the entity at the top of the cap stack or the capital stack, in first position, the lien holder is going to be the bank. So let's say that bank A, right? They have that mortgage. It's 240. The property sells for 300K. There's 60K left. And so the bank's going to use the funds, or they're going to get access to those funds first. And then the rest of that money starts to trickle down into real estate commissions, into assessments, into any fees, title, anything that went into that transaction, right? And then whatever's left over finally lands in the hands of the investor, or let's say the homeowner. That is a real world scenario of a cap stack. Now, grade A banks, I'll give you an example, kind of like Chase, Wells Fargo, Bank of America. When you're going for bigger lending products like big term loans, mortgages, or even business lines of credit, they're typically going to place what's called a UCC filing onto the business. And this is usually, again, for those type of products, regardless of the amount. This means that if, God forbid, the business went under and there's a fire sale, they get first dibs on being paid back. And then, the following would be the smaller banks, regional banks, credit unions, because they would fall down in the hierarchy of the cap stack. And so, Irv, how can I actually use this, to make more money, or to get access to more money so that I can make more money in my business? The way they can use this is that if you understand the funding process and you know which banks you need to go to first, or which financial institution you need to line up with first, that even though you'll get let's say, UCC filing from them, it doesn't affect the rest of your funding rounds or the rest of your funding requests, then you're still going to be able to get as much capital as you need, versus if you, let's say, go to a smaller bank or two smaller banks, you get, let's say, a $25,000 business as a credit, but now you have 2 small UCC filings placed onto your business credit report. Well, guess what? When you go to Chase, who possibly would have given you $100,000, you left $100K on the table simply because it was out of order. Next up is QBRs. This is going to be quarterly business reviews. Hopefully, you're already doing this inside of your business. But if not, number one, you should be, right? But if you're not, this is something that you can implement as you're working and you're building out banking partnerships, banking relationships. And so this is going to be strategic meetings that are held about the business every 3 months. Now, the purpose of QBRs is to assess the performance, discuss strategic goals, and to plan for the upcoming quarter. That's what you're doing here. So the way that you would set this up to maybe have that conversation with your bank or a business banker at your bank is you want to gather financial statements. So if you have it, you want to prepare your income statements, your balance sheets, your sales figures, cash flow statements, the whole 9 yards over the last quarter. You want to highlight any positive changes or any upward trends that you're seeing. Data is how you're going to get access to the dollars. So if you're taking notes, data is what you're going to use to get access to the dollars. Don't just wing it. Don't just walk into a bank and say, "Hey, I feel that we're doing better." Okay, cool. Like, I feel good today as well. Like, what, I felt bad yesterday, but I feel good today. Say, no. Like, do we actually have any legitimate sources or information that we can back this claim up with. Outlining your business goals for the next quarter. Banks don't want to see stagnation, and they don't want to see a return. And they don't want to see, hey, we, let's say, lended out $150,000 to this company, and we don't think we're going to see a return on this investment, or we don't feel, based off of the data that we have, that we're going to get a return on this investment because they've been kind of quiet around here. So let's just go ahead and slash your limits by like half, right? Let's start mitigating that risk. And so one of the ways that you can continue to nurture the relationship, because I know a lot of times, most people think that it's just depositing $100 into an account and that's it. Let me go crazy and start applying for a bunch of stuff. You'll want to take this to the next level, which is where the QBRs are. And so you want to have that constant communication cadence with your team of business bankers. That's how you should see them. That's how I like to describe them to our clients that we're working with is, hey, you're building out your team of business bankers. We're helping you do this. And so one of the things that we want you to do is we want to help you set up your quarterly business reviews so that when you're going in there, number one, they have the data that's going to equal to more dollars. And then number two, you're also guarding yourself, I should say, from getting the capital that you already have access to, from getting that slashed, because that happens quite a bit. And then the last thing that this does, which I love, is that when you're going through that quarterly business review and there's an upward trend, you start getting access to financial products or funding products that aren't regularly, what we say, marketed or placed out there, televised. And so you kind of start backdooring your way into more funding, which means there's less competition that you have to go up against inside of that same funding pool, which is fantastic. Next up is credit allocation. This is going to be the process of adjusting the amount of credit available within a credit account. So I want to give you a very real, very much so real world scenario. That's a lot to say. An example. So credit line A has 10K. Credit line B has 5K. So let's say that you shift 5K from A to B. You now have a total credit line of 10K on credit line B. And then obviously credit line A is going to be A. Now, if you're wondering, Irv, why would someone even do this? How does this actually help you make more money in your business? What's the point of it? Well, first off, is you're extending the period of either no or low interest. So you actually have access to cheaper money. And so if you have, for example, 2 Chase Business Inc. cards, if we're kind of staying in that line with Chase, 1 Business Inc. card, you got it as soon as you started the business. The second Business Inc. card, you got it maybe 7 months down the road. Well, guess what? With the Business Inc. card, at least at the time of this recording, it's 12 months of no interest on any purchases. But now you have on one of the cards, you have about 4.5, 5 months left before that interest starts to kick in every month. But for the new product, that window reset. And so now you have a brand new 12-month clock. So what you can do, and what some people do, is let's say if you're going to make a big purchase and you want to take advantage of no interest for that extended period of time, you transfer, again, if we're using that example of the 5K and the 10K just to work with small numbers, is you now have, instead of just having $5,000 that you were going to use for 12 months for like a big purchase, you now have access to $10,000 that you can use for that bigger purchase, which again, it's cheaper money. And that's just being smart with capital allocation, which is a skill that you want to have as an entrepreneur anyways. Number 2 is this is going to allow you to continue accessing credit even after an account closes. This is a nice, smooth way of you extending that relationship so they can continue to use the funding products. And then number 3 is you're going to maximize the points and the offers. Because if you think about it, if you're going to make a big purchase and you were going to, let's say, pay half of it in cash, and then the other half was going to be with let's say the business credit card, then you're missing out on about $10,000 worth of points and offers, which could amount into a significant amount of what we call travel rewards, especially if you are an entrepreneur who likes to travel. Like I was recently traveling, and the entire stay, the flights, everything was covered just from the natural expenses that we already have in the business. And guess what? That's going to be a business expense as well, which is going to be a tax write-off once I meet up with my accountant. It keeps your books nice and clean. Geographic Footprints. This is going to be on physical locations and on a digital presence. Now, don't confuse Geographic Footprints with Geographic Location for your business. This right here is more geared toward the bank or the financial institution. So with physical locations, this is banks that establish branches in urban, suburban, rural areas to serve local customers. So example of this is Chase has branches in all major cities. So if you go into, let's say, Central Florida, then you're going to see a Chase in like every corner. If you go to Manhattan, you're going to see a Chase in every other corner, right? That means that you can open an account essentially from wherever because you have access to a significant amount of branches. Now, the other type of what we call footprint is going to be your digital presence. Many banks extend their geographic footprint through online or mobile banking services, allowing them to reach customers beyond physical branches. This means that if you, let's say, wanted to form a banking partnership with a bank, obviously the first one we get it physical. You walk in, you're good. You're golden. The second type though gets a little I say trickier, just because the digital presence, you want to make sure that they service your, not just your state, but your city. Some credit unions, they don't allow you to open an account if you're outside of like a 50-mile radius. You can't even open it online. And so at that point, you would have to be within their area, within their scope. But if you have, and I'll use, I think it's last time I checked, there was US Bank as an example. They don't have any, like they don't, yes, they're national, but there's some states that they don't necessarily have banks in. But you can still open a checking account with them. You can still open a savings account with them digitally without walking into a branch. And so that right there serves as a data point that you can then use to, let's say, within the next 2 to 3 months, go back in and then apply for something as simple as maybe a business vehicle or equipment financing. Apply for something as simple as maybe a business credit card because you built up your relationship with them and it started from a digital presence. Speaking on banking partnerships, because we're kind of already down that, down that track, I think that this is one of the most underutilized tools that we as business owners need to be taking advantage of, especially as you start to scale your business and you start to scale your working capital, because it's not just a one and done. You're not just going to get approved for, let's say, a 50K line and call it a day. You want to continue to nurture that relationship because two things is going to come from it. First is you're going to have tailored financial products that you're going to be able to tap into. This is how you get customized financial products that suit your business's needs, such as business accounts or investment options, or again, funding options that maybe I'll give you an example. Let's say SBA, and you wanted to go like down the SBA route, and you go to an SBA approved or an SBA backed bank, and you already have a relationship with that business banker, well, guess what? You can use that as a streamlined approach to get access to some additional capital with SBA just by having that partnership in place. But the second thing that I think is really cool is you have support during financial growth periods. This is super important because as your business grows and scales, especially in down markets and when credit tightens, well, guess what? Since that partnership has already been strengthened and since it's already in place, remember what I mentioned earlier. It's kind of like having that backdoor method that you're going to be able to go in while everyone else is being turned down, and you're going to have that slight edge on the competition to get access to more working capital. Exposure limits is I would call it an uncommon one, or at least uncommonly talked about. And so if you've never seen this before, here's what it is. Credit exposure limits, this is when banks set limits on the amount of credit extended to individual borrowers, entities, and this is really how they use to mitigate risk. And so if you went right now to a bank and their exposure limit was like the max that they can give out was $80,000 for personal credit, max, that's regardless of how many credit lines you have, and then $150,000 for business credit cards, regardless of how many LLCs you bring in or how many different products you have. Like 150 is the cap. That's known as an exposure limit. They're not going to bump past that. And typically what they do is they'll watch you for a couple of months and then they'll start to kind of ease up a little bit on that exposure. This is how they mitigate the risk. Next up, you have sector exposure limits. And this is going to be the restrictions that are placed on sectors of the market. So an example is real estate or energy or construction. Banks do this quite a bit in order to not over concentrate into specific industries. Because what ends up happening, especially with high risk industries, is, and the reason why it's high risk is not necessarily that it's illegal. It's more so that the rate of which a business is defaulting inside of that industry or inside of that line of work or inside of those jobs is far higher than maybe the national average. That's ultimately what that is. And so right now, there's certain industries that 2 years ago, they weren't considered high risk. This is why it's important to pay attention to your industry. 2 years ago, they weren't considered high risk. Now they are. Well, guess what? The same time 2 years ago, that business owner would have gone in, gotten access to, let's say, an example, $80,000. Now they'll be lucky to see 20. Not because anything changed in the business, not because they're doing anything wrong, simply because the sector exposure limits changed the way the business is being underwritten, which is something that you want to pay attention to. And then lastly is geographic exposure limits. Banks often, they're going to limit their exposure in certain regions to protect against localized economic downturns. This means that, similar to what we just finished mentioning, if you have a business, it's been booming, maybe the same time 2 years ago, your specific area or your specific state, maybe the unemployment rate was totally different from where it is now, or the default rate was totally different from where it is now. But the banks, they have data. So they're starting to notice, people are starting to make, they went from paying off their credit cards in full to paying them off, in half the payments, to now they're just barely sending minimum payments, to now 1 month they send minimum payments and then the next month they miss a payment. Those are trends that they watch, and it's just happening in this area. It's just happening in the city. It's just happening in this state. That's known as a geographic exposure limit. And so that's another way that a bank is going to mitigate their risk. Number 7, strengthening your profiles. This is where you want to focus on diversifying your credit types. And so don't just overly focus on, or not just overly focusing on business credit cards, personal credit cards, not just overly focusing on car loans, not just overly focusing on a mortgage, not just overly focus on a personal loan. You want to have a nice blend. You want to have a nice blend, especially as you start to get into comparable credit, where banks like to see that you've been able to utilize credit that that you're potentially wanting them to extend out to you. So if they've seen that you've handled 1 to 2 business lines of credit, odds are they're going to say, okay, yeah, we can issue at the 3rd or the 4th. If they see that all you've used up to this point is personal credit cards, you've never had a business line of credit before, odds are you're not going to get access to a business line of credit. And so you want to slowly ramp yourself up into that. And one of the ways that you do that is by diversifying your credit, reducing the utilization. This is debt management. Limit new applications. And so you want to avoid applying for multiple, accounts in a short period of time, for multiple or new accounts, or too many new accounts in a short period of time. This looks a little fishy to financial institutions. They start to see what's going on behind the scenes. Why do you need this credit so badly? Is there something that's going on in your business that we need to know about? Because the algorithms, it's all connected and they all speak to each other. Proper entity formation is another way that you want to strengthen your profiles. Your business information is congruent, so this is going to relay with the bureaus. It's lined up there. Pull up your business credit reports with the vendors. Contact your vendors and just check. Hey, I'm looking to see, how do you guys have my name listed on record with you guys? Look at the invoice. There's a misspelling on here. Let me get that fixed, because that is the same information that's pouring into the business credit bureaus, that then that data gets pulled from the financial institutions, and that's what's working against you, and you probably don't even know it. Hitting up your creditors. Okay, my information is good there. Oh, they got my name right. They got my name spelled right. They have my business name spelled right. Oh, wait a minute. The business address is actually my home address. I told them to change that. I wanted it to be my business address. I have a virtual address that I want them to use instead. Let's get that fixed right away. And then obviously, lastly, information is lined up in your state. And you can just simply look that up either through your registered agent if they registered the business for you. We have our clients do it themselves. Hey, look it up through your registered agent, or look it up directly in the state, because that's going to give you the cleanest data. Optimize the business. Optimize the business. So second to last one. And I think that, we as business owners, we want the fixes. I get it. We're busy. We're running around. We're putting out fires. We're kissing babies. We're shaking hands. We're rubbing shoulders. But one of the main complaints that I hear a lot from business bankers when we're working with them and just some of these financial institutions is people need to know what business they're actually in. It's not just about, hey, I have, pretty good credit. I have an LLC or an S corp that I set up. How much money can I get? That's not working in this new economy, ladies and gents. And so you want to fix the actual machine that's running, which is your business. And so you want to address operational bottlenecks. Address operational bottlenecks. What's keeping our business right now if we're stuck at 250 a month? What's keeping us from getting to 450? What's keeping us from getting to $500,000 for the year? If we're stuck at $250,000 for the year, what's getting us, what's holding us back from getting to 500? Want to fix those operational bottlenecks, because apart from you getting access to more working capital, I wanted to give you this, and I want to kind of to leave it for last, because if you stuck around this long in the video, then odds are then you're legitimately looking to improve your situation. Is this: if you can fix and optimize the business as a whole, you address your bottlenecks, your financial management is on point. Obviously, you're setting clear targets. Then you're going to make more money. Like, you're going to sneeze and make more money because the actual machine is fixed. And so what's going to end up happening is that when you decide to use the capital that you've been given and you allocate it, the system is now dialed in, aka the business, because that's what a business is. It's a system. Guess what's going to happen now? By nature, you're going to make more money. It's not on accident. It's by design. And so I see I have way too many of these conversations, and I'll probably say this on blue in the face, is don't just ask for capital for the hell of asking for more capital if you don't know what the heck you're going to do with it, if you don't know what business you're actually in. I'd rather see someone line this up first before they go out for a funding round. And sometimes I'll kind of press a client and I'll say, hey, I know that you want 120. I know that you want 140. And I know for a fact we can help you get there. But what exactly are we going to use this for? Where is this being deployed? How much return are we expecting to see on this? You deploy $30K tomorrow. How much of that do you expect to get back, and in what time frame? And if I see that someone's a bit nervous, they're not, they're uneasy about the response, they're not too sure, I'm going to press them a little bit. I'm going to say, hey, I think you got to figure out the business first. Yes, we're going to help you get the business capital, but it's going to serve you so far better that once you get access to that money, you're going to make so much more money with it versus giving someone, in this case, the bank gives you a loaded weapon, which in this case is debt. And so if the debt isn't properly allocated, you end up hurting yourself. And then lastly, diversify your capital sources. This is risk mitigation. So if you are just using, let's say, one bank, and all of your funds that you're using for your projects are coming from that one bank, the minute that bank tightens up, not because you did anything wrong again, and they decide to tighten up and they slash the limit, or they just stop lending altogether for an extended period of time, that slows you down and you get caught with your pants down. Bad spot to be. And so this is how you risk mitigate. And then the second thing that you do in this spot when you diversify your capital sources is you increase access. So this expands new opportunities for funding, enabling businesses to secure the best terms and rates. And so now you have, let's say, 4 different financial institutions that you're working with, 2 of which maybe you have access to business lines of credit, and then 2 of which you just use them for maybe 0% business credit cards. Guess what? If one financial institution goes under or decides to tighten up, geographic reasons, industry reasons, climate change, I'm talking about the economic climate change, not the, physical climate change, then at that point, you're still good and you can continue to operate as needed, and you can continue to hit the targets and your KPIs as needed. So that's essentially it. Those are 9 different ways that, different strategies, different thoughts, different models that you can kind of think through and use to not just get access to more working capital, but also preserve the working capital that you have, because preservation is also a form of investing. You're not losing money. And, like Warren Buffett says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So if you found value in this video today, consider hitting the subscribe button down below and join us for weekly drops just like this. Feel free to share it with an entrepreneur that you know is going to find value in it. If you are a small business owner and you're looking to get access to more working capital that you can continue to scale with in a, again, scalable, repeatable, and sustainable way. Those are, key points there. We can definitely take a look at it with you and see how we can help you out. Go ahead and click the link down below, insideinnercircle.com. Book a call with our team. But other than that, I will see you guys in the next video. Bye.